There are moments in markets when the noise stops and the signal becomes deafeningly clear. And Friday, May 15th, 2026, was one of those moments. If you watched silver on that afternoon and felt something in your stomach that you couldn't quite name, pay attention to that feeling. It was not panic. It was not irrationality. It was your instincts recognizing a convergence of forces so rarely assembled in a single trading session that most people who witnessed it will spend years misunderstanding what they actually saw. Spot silver closed at $77.52 per ounce, down $9.21 on the day, down more than 10.5% in a single session. To put that in human terms, if you had gone to bed Thursday night holding the equivalent of 1,000 ounces of silver, you woke up Friday $10,000 poorer before you had poured your first cup of coffee. And the remarkable, the genuinely extraordinary thing about that collapse is not what it revealed about silver's weakness. It is what it revealed about silver's position at the precise intersection of every major macro force operating in the world right now, simultaneously, in the same week, like some kind of financial stress test that nobody designed but everyone will be studied for years to come. This is the part of the story that matters. Silver did not fall because its fundamentals eroded. Silver fell because three separate earthquakes struck at the same moment, and silver, sitting at the crossroads of monetary metals, industrial commodities, and global risk sentiment, absorbed all three. Understanding those three earthquakes is the only way to understand what Friday actually meant, and more importantly, what it did not mean. Earthquake 1 came from Washington. On Tuesday, May 12th, the Bureau of Labor Statistics released the April Consumer Price Index. The headline number was 3.8% year over year, above the consensus estimate of 3.7%, and the highest reading since May of 2023. That alone would have rattled markets, but the Bureau was not finished. 24 hours later, on Wednesday the 13th, came the April Producer Price Index, the measure of what producers pay before goods ever reach a consumer's hands. Final demand producer prices advanced 1.4% in a single month against a consensus near 0.4%. The trailing 12-month producer price reading hit 6%, the highest since December 2022. Nearly 60% of that April wholesale surge came from the services component, the exact part of the inflation tape that the Federal Reserve watches most obsessively. In plain language, wholesale prices just printed their hottest reading in nearly 4 years. The pipeline that feeds consumer prices has not finished draining through, and the Federal Reserve now walks into its next meeting with the hottest combined inflation data since the post-pandemic surge sitting on its desk. The federal funds futures market understood the implication immediately. Per CME Group FedWatch, the probability of any Federal Reserve rate cut in 2026 has collapsed to near zero. The probability of a rate hike by December has climbed to approximately 50%. 1 week before Friday, that hike probability stood at 16%. 2 weeks before Friday, the market was still pricing in 2 rate cuts for the calendar year. 30 percentage points of monetary policy expectation rewrote itself in 7 calendar days. When the cost of holding a non-yielding asset rises, when the opportunity cost of owning silver instead of a treasury that now yields 4.59% on the 10-year becomes mathematically heavier, the paper market sells. That is not irrational, that is arithmetic. Earthquake 2 arrived from Capitol Hill, and it carried a name, Kevin Warsh. On Wednesday the 13th of May, the United States Senate confirmed Warsh as the 11th chair of the modern Federal Reserve era by a vote of 54 to 45. The slimmest confirmation margin ever recorded for a Federal Reserve chair. Every single committee vote had already split along party lines, the first fully partisan committee advancement of a Fed chair in the committee's history. And yet the most remarkable detail is not the margin, it is what comes next. Jerome Powell, the outgoing chair, will remain on the Board of Governors through January 2028. That is the first time in nearly 80 years that a departing Federal Reserve chair has returned to sit on the board after surrendering the chairmanship. There are now 2 chairs in the same room. That has no modern precedent. Warsh's first Federal Open Market Committee meeting as chair is scheduled for June 16th and 17th, exactly 1 month from today. That meeting comes with an updated summary of economic projections, the dot plot, the Federal Reserve's public forecast of its own interest rate path. The last dot plot, released in March, still projected at least 1 quarter-point rate cut for calendar year 2026. If the June dot plot removes that cut entirely, or, more critically, pencils in a hike, silver's consolidation does not end in the 3rd quarter. It extends into the 4th, and possibly beyond. Warsh's own published record from his prior governorship between 2006 and 2011 places him among the most hawkish voices in the institution's modern history. He opposed quantitative easing when the balance sheet first crossed $4 trillion. He called last year for regime change at the central bank. The most prominent monetary policy hawk in the Fed's recent public record now controls the most consequential institution in global finance, confirmed by the narrowest margin in history, with a structural check sitting one chair away. That is the institutional environment in which silver is now trying to find a floor. If the inflation data and the new Federal Reserve Chair were the first two earthquakes, the third was geological in its scale, and it began not in Washington or New York, but in the waters between the Persian Gulf and the Gulf of Oman, in the 33-mile-wide passage through which, before the 28th of February 2026, approximately 21 million barrels of oil flowed every single day. The Strait of Hormuz, operationally closed. And the implications of that closure are now embedded in every price you see. Every inflation print, every energy bill, every producer cost number, every Federal Reserve projection, every silver tape. You cannot understand Friday's silver crash without understanding the Strait of Hormuz, because the Strait of Hormuz is the reason the inflation tape is running this hot to begin with. Per the International Energy Agency, crude and fuel flows through the strait dropped by approximately 4 million barrels per day during March and April. Earlier first-quarter readings from the United States Energy Information Administration estimated the flow decline at closer to 6 million barrels per day at the peak. Approximately 30 vessels crossed the strait since Wednesday evening of this past week, against the roughly 140 that transited each day before the war began. Saudi Arabia has formally informed OPEC that its oil production has dropped to the lowest level since 1990. West Texas Intermediate July futures rose above $113.50 per barrel on Friday, on track for a weekly gain of approximately 10%. Brent crude strengthened above $116 per barrel, on track for a weekly gain over 5%. Per Wood Mackenzie analyst Alan Gelder, the expectation for Brent crude during the first quarter of 2026, before the war, had been below $60 per barrel. It has been trading above 110. That is the energy shock. That shock produces wholesale price inflation. That wholesale price inflation produces consumer price inflation. That consumer price inflation produces a Federal Reserve that cannot cut rates. And a Federal Reserve that cannot cut rates produces the selling pressure that hammered silver on Friday. The chain of causation is not mysterious. It is direct and it is sequential. Now here is the part that will not show up on the Friday ticker tape, but will matter enormously for what happens next. While Kevin Warsh was being sworn in and silver was being sold, President Trump was in Beijing for the first American presidential state visit to the People's Republic of China in nearly 9 years. The two-day summit closed on Friday the 15th with one announced trade deliverable, a Chinese commitment to order 200 Boeing aircraft. That is it. Per the Financial Times, President Xi conceded little. The Taiwan question dominated the opening of the summit, with Xi warning that mishandling the issue would put the American-Chinese relationship into great jeopardy. On the Iran question, Trump told Fox News that Xi had offered to help with peace negotiations and had ruled out sending Chinese troops to support Tehran, but no formal public commitment emerged. No agreement on rare earth supply. No resolution on the Nexperia semiconductor dispute. No concrete movement on the fentanyl precursor compliance question. No announcement on the rare earth export control restrictions Beijing imposed in October 2025. The pressure release valve the market was hoping for did not open. This matters for silver in ways that extend well beyond Friday's session, because China is not merely a geopolitical actor in this story. China is a physical silver actor. Beijing holds one of the largest concentrations of physical silver inventory in the world. The rare earth restrictions are not separate from the silver story. They are part of the same strategic resource calculus. America walked out of Beijing with a Boeing order and a photo of roast duck at the Zhongnanhai leadership compound. China walked out with its rare earth hand, its semiconductor hand, and its physical silver inventory hand entirely intact. Here is where this script owes you something that most financial commentary will not deliver: the honest bearish case. Because the structural deficit narrative, and it is a real narrative supported by real data, does not automatically translate into near-term price appreciation when the macro environment is aligned against you. Per the Silver Institute and Metals Focus World Silver Survey 2026, published April 15th, the global silver supply deficit is projected at 46.3 million ounces for calendar year 2026, the sixth consecutive annual deficit. COMEX registered silver, the deliverable category, sits at approximately 79.88 million ounces. The delivery coverage ratio stands at 13.4%, the seventh consecutive month below the 15% stress threshold. The London Bullion Market Association's Loco London Vault system held 27,454 tons of silver at the end of April, valued at approximately $64.9 billion, down roughly 7,000 tons from the all-time peak of 34,346 tons recorded in January 2021. The physical inventory picture is tighter than it has been in years. And yet, the photovoltaic silver demand story that powered so much of the bull case is facing structural headwinds of its own. Per EBC Financial Group, citing PV Magazine and Metals Focus, solar panel silver demand fell 6% in 2025 to 186.6 million ounces and is forecast to fall a further 19% in 2026 to approximately 151 million ounces as manufacturers continue to reduce silver content per cell. LONGi Green Energy is commercializing copper paste-backed contact cells. Aiko Solar is shipping silver-free heterojunction cells in commercial volume. The Indian government raised import tariffs on gold and silver from 6% to 15% on the 13th of May, a direct demand shock to one of the world's largest physical bullion markets. The iShares Silver Trust has recorded persistent net outflows through the first quarter of 2026, including a single-day redemption near $3.4 billion during February's turbulence. Silver's 2026 low was $67.91 per ounce on the 20th of March. A sustained break below the $70 consolidation boundary could retest the high 60s before any meaningful structural buyer returns. If you are still reading this, if you have followed every data point through 2 full sections of this analysis, then you understand something that most people watching the Friday tape did not. This market is not simple, and anyone who tells you it is should be regarded with professional suspicion. But there is one more layer, and it is the most important one. Markets have a habit of doing their most interesting work at the exact moment they look the most broken. The Friday tape read like a verdict: 10.5% down in a single session, gold falling, Treasury yields blowing through a one-year high at 4.59% on the 10-year and 4.09% on the 2-year. The University of Michigan Consumer Sentiment Index printing at 48.2, the lowest reading ever recorded since the survey began in 1952. Mining stocks in London bleeding out, with Fresnillo plc, the largest pure-play silver miner on the FTSE 100, closing at 3,373 pence, down approximately 9% in a single session. Anglo American down 6.2%, Hochschild Mining tumbling 6.4%, Endeavour Mining losing 6.6%. The FTSE 100 mining complex dragged the broader index down 1.18%, trading at 10,250, and through all of that, the physical inventory numbers did not move. The LBMA Loco London Vault figure did not change because of Friday's futures sell-off. The COMEX delivery coverage ratio did not improve because paper silver was sold. The 6 consecutive years of global supply deficit did not get erased by a hot inflation print. The Strait of Hormuz remained closed. Saudi production remained at its lowest level since 1990. The structural picture in the paper price diverged on Friday in a way that is historically significant. Not because it guarantees a recovery, but because divergences between physical fundamentals and paper prices are precisely how the most important turning points in commodity markets have historically been established. Here is where intellectual honesty requires this script to hold 2 truths simultaneously. The first truth: the macro environment is genuinely hostile to silver right now. Near zero probability of a 2026 rate cut, approximately 50% probability of a December rate hike, a Federal Reserve chair with the most hawkish public record in the institution's modern history, a firming dollar index at 98.5, a 10-year Treasury yield at 4.59%, record low consumer sentiment, softening retail sales, an energy shock driving the inflation tape that is driving the rate expectations that are driving the paper selling. These are not manufactured headwinds. They are real, they are documented, and they do not resolve quickly. The second truth: the January 29th all-time intraday high of $121.67 per ounce now sits approximately 36% above where spot closed on Friday. The Reuters consensus 2026 average silver price sits at approximately $79.50, broadly in line with current spot even after Friday's carnage, which means the analyst community has not yet materially revised its structural view. The paper-to-physical leverage in the COMEX system continues to run at multiples of deliverable supply. The Sprott Physical Silver Trust, which holds fully allocated London good delivery silver stored in Royal Canadian Mint vaults, continued institutional accumulation through the first quarter as the iShares paper side experienced its outflows. Physical buyers and paper sellers are right now operating in the same asset simultaneously, with opposite conviction. Do you want to understand markets at a level that most people never reach? Then subscribe right now, because this is not the kind of analysis that gets packaged into a 30-second clip or a social media post. This is the work. And the next 30 days of data will be among the most consequential this market has seen in years. The June 16th and 17th Federal Open Market Committee meeting is the next fulcrum. If the updated dot plot removes the last projected 2026 rate cut or introduces a hike projection, silver's consolidation extends. If the Strait of Hormuz situation moves toward resolution, through the Iran negotiations that Trump warned were approaching a deadline, through the Saudi production situation, through any shift in the energy picture, the inflation tape that is driving the rate expectations begins to cool. If physical delivery pressure at COMEX reaches a point where the coverage ratio, currently at 13.4% for the 7th consecutive month below the 15% stress threshold, forces a structural response, the paper and physical price discover their reconciliation. None of these outcomes is certain. All of them are live. What Friday actually was, stripped of the noise, stripped of the panic, stripped of the breathless headline coverage, was a forced deleveraging event. Leveraged holders liquidated their most liquid positions. Silver, simultaneously a monetary metal and an industrial commodity, absorbed selling from both directions. The physical inventory pool underneath did not drain. The structural deficit did not close. The vault numbers did not improve. What changed on Friday is the paper price. And paper prices and physical fundamentals have a long history, in commodities, of eventually reconciling. The direction of that reconciliation and the timeline is exactly what this market is now in the process of determining. Here is the complete picture as Saturday morning of May 16th, 2026 opens. Spot silver, approximately $77.52 per ounce, rebounding to $78.44 this morning. Spot gold, approximately $4,564 per ounce. Gold to silver ratio, approximately 58.9. WTI July futures approximately $113.50 per barrel. Brent crude approximately $116 per barrel. Dollar index approximately 98.5. 10-year Treasury yield 4.59%. 2-year Treasury yield 4.09%. April CPI 3.8% year over year. April core CPI 2.8%. April PPI 1.4% month on month, 6.0% year over year. COMEX registered silver 79.88 million ounces. Delivery coverage ratio 13.4%. LBMA Loco London Vault 27,454 tons. Silver Institute 2026 deficit projection 46.3 million ounces, 6th consecutive year. Strait of Hormuz still closed. Saudi production at the lowest level since 1990. Warsh confirmed. Powell remaining on the board. Trump-Xi summit closed with no major breakthrough on Iran, Taiwan, rare earths, or semiconductor flow. Every number on that list is a primary source number. Every one of them is verifiable. Pull each one yourself. That has always been the only point of doing this kind of work. Not to tell you what to think, but to give you the information required to think for yourself. And if this analysis gave you a clearer read on how this market actually moves, then drop your thoughts in the comments below. Tell me which data point hit you hardest. Tell me what you think the June dot plot reveals. Tell me what you believe the Strait of Hormuz resolution timeline actually looks like. The best conversations in markets are not between experts and audiences. They are between people who have done the work together and are honest about what they do and do not know. That is what this desk has always been for. The wholesale inflation print this week was the hottest in nearly 4 years. The new Federal Reserve Chair was confirmed on the slimmest margin in modern history. The Beijing summit closed without resolution on any of the structural questions that actually matter. The Strait of Hormuz is still closed. London's Fresnillo fell 9% in a single session. COMEX coverage sits at 13.4% for a 7th consecutive month. The Silver Institute has formally written 6 consecutive years of deficit into the public record, and the LBMA Loco London Silver Pool has drained by roughly 7,000 tons from its all-time peak. Friday's crash did not break any of that. It reopened the question of when those structural forces and the paper price finally reconcile, and that is the question that will define the next chapter of this market. Pay attention. Think carefully. Do not let noise substitute for analysis. And remember, this is for education and discussion only, not personal financial advice. I am sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind. All prices and data reflect May 15th through 16th, 2026 market sessions. Primary sources: USA Gold Daily Precious Metals Report, Trading Economics Commodity Desk, BLS CPI PPI releases, CME FedWatch, LBMA Vault Data, Silver Institute World Silver Survey 2026, Advisor Perspectives Treasury Yield Snapshot, COMEX Registered Inventory Data.